Welcome to the Deep Dive, where we sift through the full stack of research and intelligence briefings to pull out the signals that really matter. Today, we're looking at a briefing from December 18th, 2025, and it paints a really fascinating picture, a total paradox, really.
It really is.
On one hand, you have short-term price action that looks, defensive, it's consolidating, drifting down towards that $86,000 support zone.
Right. A lot of noise.
But on the other hand, the underlying structural entrenchment of this whole asset class is just, it's accelerating at an incredible pace.
And that's the core theme of this deep dive. We're calling it convergence. The lines are just blurring everywhere.
Convergence in what sense?
Well, the briefing points to three key areas. First, you have industrial Bitcoin mining literally merging with high-performance computing for the AI sector.
Okay.
Second, you're seeing stablecoin settlement layers being pulled directly into the core U.S. banking system. And third, sovereign adoption is evolving. It's moving from just passive accumulation to, active economic structuring.
So our mission today is to help you reconcile that short-term market noise with this huge, long-term structural signal to really understand what these transformative events mean for the asset class.
Exactly. Signal from the noise.
Okay, let's unpack this. Let's start with the immediate market picture. The last 24 hours have been, pretty rough.
Yeah, defined by price compression. We started the period up near 87,150.
And then?
It just relentless algorithmic selling. It pushed the price down to a local low of around 85,300.
And this wasn't happening in a vacuum, right? There was wider market weakness.
Exactly. It coincided with a pretty significant drop in U.S. equities. The S&P 500 fell over 1.1%. So, the whole macro environment was heavy.
And of course, when spot gets heavy, the derivatives market just lights up. We saw that classic BART pattern swing.
We did. Over just 2 hours, it was wild. Price first surged up to $90,000.
Which took out all the shorts.
Wiped out $120 million in shorts. And then almost immediately, it just collapsed back down to 86,000.
Flushing out $200 million in longs on the way down.
All told, when you add it all up, it was almost $575 million in liquidations, just cleaned out.
So you'd think, okay, all that leverage is gone, the market should be healthier. But the sentiment metrics tell a completely different story.
A completely different one. The crypto fear and greed index just plummeted. It hit 16.
16? That's extreme fear.
Extreme fear. It's the lowest we've seen in 3 weeks. The technical structure just shifted from bullish to, sideways at best. That 85.6 to 85.8 support level is now absolutely critical.
So why so much fear if the weak hands have been cleared out? Is it just macro pressure?
It's a huge part of it. You've got the quarterly derivatives expiry coming up, witching Friday. That always drives hedging and weird price action.
And the Fed isn't helping.
Not at all. You have Fed President Williams hinting at possible near-term rate cuts. But the market is just full of caution right now. Nobody wants to commit.
And we saw something strange with the dollar index, the DXY. The usual inverse correlation with Bitcoin, it sort of broke down.
It did. And the likely reason for that is the Japanese yen. There's this growing anticipation of a rate hike in Japan, and it's causing this huge unwind of the yen carry trade.
Right, where investors borrow cheap yen to invest elsewhere.
Exactly. And now that money is flowing back to Japan, which drains liquidity from global markets, it hits high-risk assets like crypto especially hard.
Okay, but here's the paradox. While all this fear is happening, the biggest players are doing the exact opposite.
This is the divergence. U.S. spot Bitcoin ETFs saw net inflows of a massive $457 million yesterday.
$457 million in the middle of a dip.
It's a staggering number.
Yeah.
And it tells a powerful story.
And the breakdown is even more telling. Fidelity's FBTC was the leader here.
By a long shot. They pulled in $391 million. That's way more than BlackRock's iBit.
And why is that significant?
Because Fidelity's main clients are registered investment advisors, RIAs, wealth managers. This is sticky long-term capital. They see a dip driven by fear, and they don't panic. They see it as a buying opportunity for their clients.
So the smart money is buying the fear. Okay, let's pivot from that short-term noise to the long-term structural signal. This is where it gets really interesting, with miners and AI.
This is probably the most transformative development in the briefing. The whole business model for mining is being rewritten.
You're talking about the Hut 8 deal.
The Hut deal, a landmark partnership. They confirmed a $7 billion lease over 15 years with Anthropic and FluidStack.
An AI company and a cloud provider.
Right, and we're talking about huge scale. It starts with 245 megawatts of infrastructure, with the potential to scale up to over 2,000 megawatts.
But the real insight for me wasn't just the size of the deal, it was the backstop.
Yes, Google is providing a financial backstop for the lease payments.
Which is huge. It completely de-risks the entire thing. It turns Bitcoin miners from cyclical commodity producers into infrastructure utilities.
That is the perfect way to put it. They are no longer just selling hash power. They are selling guaranteed long-term energized capacity. And it's backed by one of the biggest companies on the planet.
We're seeing this sophistication in how other miners are raising capital too, like CleanSpark.
Yeah, they just did some incredible corporate finance work. They completed a $1.15 billion convertible senior notes offering.
So in simple terms, what does that mean for them?
It means they got over $1 billion in cash, effectively interest-free. Instead of paying cash interest, they give the note holders a small slice of potential future stock growth. It's a really smart way for a growth company to raise cheap capital.
And what they did with that capital is what stands out. It's a huge vote of confidence.
It really is. They immediately used about $460 million of it to buy back their own shares, about 11% of their outstanding stock.
So they're signaling to the market that they think their stock is undervalued.
Precisely. They're saying, we believe our future in AI infrastructure is so big that buying our own stock right now is the best use of this capital. And the rest is earmarked for more land and data center development.
So if corporations are finding stability in energy, what happens when a nation does it? This brings us to Bhutan.
Yeah, this moves us to the geopolitical stage. And it's a huge leap forward for sovereign adoption. Bhutan has committed up to 10,000 Bitcoin.
Which is worth, what, close to $1 billion?
Somewhere between 860 million and $1 billion, yeah. They're pledging it from their sovereign reserves to fund the Jellifu Mindfulness City.
And this is the paradigm shift we talked about. This isn't El Salvador just putting Bitcoin on the balance sheet.
No, not at all. This isn't passive accumulation. They're using Bitcoin as an active capitalization tool, as pristine collateral.
So they can borrow against it without selling it.
That's the idea. They can use the BTC to secure funding for the city's infrastructure, roads, power, you name it all, without having to sell their principal holding. It moves Bitcoin from just a store of value to a productive, active asset for a nation-state.
And they didn't stop there. They also launched a sovereign-backed digital token.
Right. It's called TEE. It's fully collateralized by physical gold, and interestingly, they chose to issue it on the Solana blockchain.
Which is a pretty big vote of confidence for Solana.
It is. They cited its speed and throughput. And look at the partners they brought in. DK Bank for custody, Matrix Stock for tokenization, and Cumberland DRW to manage their reserves.
Yeah.
This is a top-tier institutional-grade strategy.
And we should just briefly note other nations are experimenting too. The Marshall Islands are moving forward with a universal basic income plan paid out in crypto.
It's a growing trend. So we connect all this back to the U.S. while the world is innovating. The U.S. financial system is finally adapting its rules to make room for these assets.
Let's talk about those regulatory unlocks, starting with the SEC and custody.
This is a really important one. The SEC issued guidance on Rule 15c33, the Customer Protection Rule. It's a core piece of Wall Street regulation.
And the clarification was about what counts as possession or control for a digital asset.
That's right. The guidance now says a broker-dealer can demonstrate control by maintaining exclusive control of the private keys. It seems obvious, but getting that in writing removes a massive legal ambiguity.
So this basically opens the door for the big Wall Street firms to offer direct crypto custody.
It opens the floodgates. Now they can hold the assets themselves for their institutional clients, which is what those clients have been waiting for.
And what about on the stablecoin front?
There, the FDIC is paving a concrete path forward. They've issued proposed rulemaking for the Genius Act,
Which outlines how banks can issue stablecoins.
Exactly. It's an application process for FDIC-supervised banks to issue payment stablecoins through regulated subsidiaries. It officially brings stablecoins under the banking umbrella. They're being legitimized as a real banking product.
So as the regulations get clearer, the technology is also getting better. The Lightning Network, for instance.
Yeah, Layer 2 innovation is just accelerating. Lightning's public capacity hit an all-time high, over 5,600 Bitcoin locked on the network.
But the big problem for payments on Lightning has always been the volatility of Bitcoin itself.
And that's where Tether's latest move is so important. They just invested $8 million into a processor called Speed.
And the goal there is?
The goal is to enable stablecoin transfers, like USDT, directly over the Lightning Network. So you get the speed and low cost of Lightning, but without the price volatility of Bitcoin. It's a potential game changer for payments.
And this is moving from retail to institutional now.
It is. BitGo, which is one of the biggest qualified custodians, just announced they'll support Lightning directly from their custody platform.
Which is a huge deal for businesses.
It's essential. It means a company can now use Lightning for things like payroll without ever moving funds out of secure, qualified custody into a risky hot wallet. It removes a major barrier to corporate adoption.
And finally, on the innovation front, we have to talk about Coinbase. They seem to be thinking much, much bigger.
We're going for the super app strategy. It's a massive expansion. They're launching stock trading, prediction markets, a tokenization platform, even an AI investment advisor.
So they want to be more than just the place you buy crypto.
They want to own a much bigger share of wallet. It's a clear move to reduce their dependence on the brutal crypto boom and bust cycles and compete with traditional finance head-on.
Okay, we have to balance all this positive innovation with the reality of the operational risks that still exist.
Of course. And on that front, we saw both a major win and a major failure.
Let's start with the win.
The win was for the Solana network. It was hit with a massive, week-long DDoS attack. We're talking peaks of 6 terabits per second.
And the result?
Zero downtime. The network didn't flinch. It's a huge validation of their architectural upgrades, and it proves it can handle high-value, commercial-grade use cases.
But then we have the failure, the centralized risk.
Right. The Indian exchange CoinDCX suffered a $44 million security breach.
How did it happen?
A sophisticated server breach. Compromised private keys for their liquidity provisioning hot wallets. It's another painful reminder that centralized exchanges remain a major point of vulnerability. And we should also mention that regulators are still very active. The SEC charged the founder of VBit Technologies with a $48 million fraudulent scheme. So they're still policing the space very closely.
So after all that, what does this mean for you, the listener? How do you make sense of this? It feels like the market is in a state of cognitive dissonance.
That's the perfect term for it. The noise is the price action, the leverage flush, the fear.
Yeah.
But underneath it all, the structural signal is getting stronger every single day.
And that signal is made up of these new de-risking factors.
Exactly. You have a new, tangible valuation floor for miners because of the AI convergence. You have real utility validation happening with Lightning and stablecoins. You have sovereign utility being proven by Bhutan.
And you have a clear regulatory pathway being built by the SEC and the FDIC.
So the short-term volatility is just that. It's noise. The signal is the deep, profound entrenchment of this asset class into the global energy, sovereign, and banking sectors.
Which brings us to a final provocative thought for you to consider.
Given everything we've discussed, the structural maturity, the powerful institutional demand that we see in the ETF flows, is the extreme fear in the market today, that fear and greed index at 16. Is that really a sign of a coming crisis?
Or is it something else?
Or is it simply providing the cheapest possible entry point for the exact kind of long-term sticky capital that clients at places like Fidelity and BlackRock are deploying right now? It's something to think about as you watch the market navigate this year-end volatility.